to our Moments with our Investment Gurus webinar. We hope you enjoyed the discussions today. Just some housekeeping. We applied for Continuous Professional Development or CPD points. It's important to please watch the full session and add your ID number to the CPD section so we can verify your attendance. You may also view this event on this platform at any time until the end of April and still receive your CPD points. The CPD certificates will be mailed to you during May 2023. Please also feel free to ask questions in the Q&A section, and our speakers will either answer them live or get back to you after the event. You will also find more information about our speakers under the Speaker tab on the top menu bar, or if you scroll down, and you can download the PDF presentations. I do hope that you enjoy this session and find it valuable. First up is Theo Terreblanche, our Executive Head of Investment Management, who will do a brief introduction. Take it away, Theo.
Thank you, Mike, and good day, everyone. The year has certainly started off with a bang, and I can't believe we're in March already. We're pleased to host the next installment of our webinar series, Moments with our Investment Gurus, and I'd like to thank you for your attendance today and your support for our business. Markets continue to be volatile, and questions around when and if inflation will return to normal levels, how central banks around the globe will react, and whether economic growth will lag consequently remain. I'm sure you will agree with me that investors today face multiple risks to their portfolios. But as always, these risks also bring about opportunities if you know where to look. Before delving into the detail, it's always useful to take a step back and reassess the state of the global economy and the effect this has on various asset class returns. Just a brief overview then of what we've got lined up for you today. Our economist, Sinisha Pakrasamy, will kick off this morning's session and share her views on the topic. Our acting CIO, Mike Atsitz, will moderate a panel discussion with various experts from Momentum Investments, Rubico and Sentio Capital. The question the panel is grappling with today is whether the current cycle is a repeat of what we've seen before or whether the global economy has changed permanently. This promises to be a fascinating discussion. Keegan Dodo, a senior portfolio manager in our fixed income team, will then discuss the various opportunities the current cycle brings about for fixed income portfolios. He will hand over to Stanley Bishu, a portfolio manager in our systematic strategies team, who will share how strategies in this area are evolving. Mike Atsitz will close today's session for us and share his key takeaways. As always, please feel free to reach out to us afterwards if you'd like to engage further on any of the topics discussed or if you have any questions. Thank you.
Thanks, Theo. Really insightful stuff. Next is our economist Sinisha Pakrasamy, who will discuss the key elements of the Great Reset in financial markets and the implications for key economic variables. The stage is all yours, Sinisha.
Hello, everyone. Aside from the effects of the COVID-19 pandemic still reverberating worldwide, a series of mutually reinforcing shocks further struck the global economy last year. The war in Ukraine reignited food and energy inflation, and higher price pressures spilled over into other areas of the consumer basket. This forced up interest rates at the fastest pace in decades. A cost of living crisis gripped many nations, worsening food insecurity in parts of Africa, Asia, and South America. Alongside economic hardship, climate-related disasters inflicted humanitarian crises and furthered economic damages. What a year! It's no wonder that against this backdrop, which analysts are referring to as the Great Reset, it will be difficult for growth in the globe to emerge strongly this year. In January, the World Bank released projections for a slowdown in global growth to 1.7% for 2023. This would leave growth at its weakest pace in nearly 3 decades, overshadowed only by the global financial crisis of 2009 and the pandemic in 2020. 8 months ago, the globe was expected to grow at 3% this year, but more aggressive monetary policy tightening, a deterioration in financial conditions, and declining confidence have led to growth downgrades by the World Bank in nearly all of the advanced economies they cover, and about 2/3 of all economies in the emerging market world. A lasting impact of these economic shocks has consequently led the World Bank to downgrade growth forecasts for half of the economies globally next year. The sharpest rise in central bank rates in decades, together with no pending resolution to Russia's war in Ukraine, are likely to continue dampening growth prospects this year. You would have to go all the way back to the late 70s to experience a similarly sharp pace of interest rate tightening that we observed over the course of 2022. While at 4.75%, interest rates in the United States are at the highest rate they've been since 2007, yet a surprisingly strong jobs report in January underscores the need for continued restrictive policy. Market-implied policy rates indicate a further 80 basis points of interest rate hikes in the US to peak in the third quarter of this year, close to 5.5%. Across the Atlantic, a number of European central bank officials have intimated that markets may have been too optimistic about inflation trends, signaling more to come. Interest rates in the Eurozone have been hiked by 300 basis points so far, leaving policy rates at their highest level observed since late 2008. Markets are pricing in the end of the hiking cycle in the Eurozone in the third quarter of this year and are signaling a possible peak in interest rates of 3.75%. Central banks have tried to signal that they have more work cut out for them to truly vanquish inflation, and they have upfront stated an intention to bring inflation back down to pre-pandemic levels. However, financial market participants are just not buying it. Markets are betting that inflation will dissipate rapidly and that interest rate cuts will arrive sooner than central bank officials themselves are signaling. That level of conviction has driven a relatively buoyant start to the year in markets. The risk-off bid for the dollar has reversed, and we've seen a steep 11% depreciation in the US dollar since its peak of below parity in late September last year. Moreover, stocks and bonds have recovered strongly year to date after being torpedoed during 2022. Last year was truly an anomalous year, insofar as the traditional inverse relationship between the performance of bonds and stocks collapsed in response to decades-high inflation and a sharp rise in interest rates. This sets a big question for financial markets this year in terms of who will prove to be right. A rapid and synchronized pace of monetary policy tightening by key central banks across the globe has pulled liquidity out of markets in a reasonably short space of time, leaving economies in a more vulnerable position. Signs are becoming increasingly apparent that the aggressive pace of monetary policy tightening has started to cool demand and lessen inflation. However, the International Monetary Fund, or IMF, notes that the full impact of this tightening is unlikely to be realized in its entirety before 2024. This alludes to weaker growth prospects ahead. Central banks are finding themselves at a critical juncture. Economic prospects have weakened considerably due to tighter policy, but inflation is not quite yet under control. Global inflation averaged nearly 9% last year, but is set to decline this year. The IMF notes that global inflation likely peaked in the third quarter of 2022, with food and fuel price inflation coming off. Weakening demand and easing commodity prices, which have driven disinflation, which is positive but declining inflation across a number of economies. The World Bank shows that whereas 90% of economies were experiencing accelerating inflation in June last year, by November, only 30% of economies were in that position. Inflation has risen across a broad range of goods and services. While headline inflation is decidedly moving lower, core or underlying inflation has not yet peaked in most economies, given second-round effects from earlier shocks. Tight labor markets resulting in robust wage growth has in addition created spillover effects from that initial round of inflation. Nevertheless, contracting money supply in the United States, slowing activity due to substantial monetary tightening over the past year, and easing supply chain disruptions should eventually also lead to lower core inflation albeit with a lag. Although shorter-dated inflation expectations reacted to higher commodity prices, longer-dated expectations have been far more stable. Inflation expectations are important for central bank decision-making and their communication strategies to the broader public, since they have a direct influence on consumption decisions and wage demands, which then in turn underpin price setting at a business level. The gap between shorter-dated and longer-dated inflation expectations reveals that households have given less weight to current inflation when formulating their long-term expectations. This also gives central banks a bit more comfort that households and financial markets have not lost faith in central banks' ability to influence inflation despite the breach in inflation targets currently. Now, this is a key shift in thinking since the 70s stagflationary episode, when central bank credibility came under significant threat. Despite the continued downtrend expected in inflation in the coming months, disinflation will still take time, and it may be a while before inflation returns back to targets. The IMF warns that headline inflation will still be above pre-pandemic levels in 82% of economies in 2024, and core inflation will exceed pre-pandemic levels in 86% of countries in 2024. As such, inflation persistence remains a key risk to the global economy to the extent that a more aggressive monetary policy response or higher interest rates for longer can have a deeper negative effect on growth. The IMF notes that positive surprises and greater economic resilience in a number of countries has led to a less negative outlook than previously. Since October, their growth outlook has brightened. However, they continue to note that even though the most adverse threats have likely abated, the balance of risks remains firmly tilted to the downside. As such, the risk of a recession in key economies remains high, with a number of key indicators flagging a rising risk of recession. The leading indicator for the United States, consumer sentiment, residential investment in real terms, services PMI, mortgage lending standards, and even the equity market at times have been at levels consistent with those experienced during a downturn in the economy. Moreover, a more deeply inverted yield curve is questioning confidence in the economy's ability to withstand additional interest rate hikes. As such, a prolonged rise in inflation poses a key risk to our global view. More aggressive interest rate tightening, relative to what is currently baked into markets, would undermine household purchasing power even further from currently weak levels. Wages have not kept pace with high inflation, resulting in the biggest loss in real income since the 70s. Since 1990, there has been a greater opening of the global economy, leading to the free flow of people, goods and services, ideas, and even capital. This period also led to China opening up to capitalism, and we also experienced the emergence of the so-called Asian tigers. These high-growth economies were fueled by exports and rapid industrialization. This period of trade liberalization ushered in lower volatility in both inflation and growth, which resulted in a higher level of macroeconomic stability. The lingering pandemic and the ongoing war in Europe has made the world experience a slowdown in the pace of globalization, or what the IMF refers to as slowbalization, which is reshaping the way in which we conduct business and trade. Regional trading blocs and friendshoring have emerged as alternatives to actively access global markets while escaping the fragility of supply chains that became evident during the pandemic. The shift to globalization feels like a regime shift, given that it has been accompanied by higher levels of volatility, a wider range in macroeconomic forecasts, and shorter and sharper cycles. However, outside of a shift in trade dynamics, a few other pillars which were instrumental in lowering volatility between 1990 and 2016 have undergone a fundamental change. This suggests that we may be returning to a regime akin to that prior to 1990, where cycles were shorter and sharper, the range of macroeconomic forecasts and outcomes were wider, and uncertainty and volatility were more elevated. Chatham House notes that unlike the 90s, the scales have tipped towards greater suspicion of globalized approaches, making it more difficult to collaborate on an international scale when dealing with global challenges such as poverty, health outcomes, and climate change. The first pillar, previously supporting a more stable regime between 1990 and 2016, has been disrupted by the emergence of more power nation-states, an increasing push for local solutions, as well as more border controls and protectionism. The collapse in the second of these pillars is related to a world with less abundant liquidity. The need to quell inflationary pressures caused central banks to pivot their view on monetary policy to a more restrictive stance, and as such, balance sheets have also been reined in. The third pillar previously rested on high single-digit growth rates out of China. However, going forward, it is reasonable to expect much slower trend growth in the Asian giant, given policy efforts to drive the economy away from export and manufacturing dependence to more consumer and services-driven output. The fourth pillar of a more stable environment has been interrupted by the global spread in political polarization. A painful increase in poverty and inequality has urged electorates to challenge the political status quo. The Carnegie Endowment for International Peace claims that political polarization is tearing at the seams of democracies around the world. They attribute more divisive societies to the rise of social media, more aggressive opposition leaders, a sharp increase in patronage and corruption, as well as growth in middle-income classes, merely highlighting those who have been left behind. These stark political divides are likely the source of the recent rise in political violence, which further stymies economic and social development. This shift in the political discourse has placed institutions essential to democracy under significant threat. The Brookings Institution claims that the rule of law and democracy are crucial to capital markets. A free market, they say, balanced by a democratically elected, transparent, and capable government, together with a strong civil society, yields stable economic growth rates and greater gains in social welfare. However, with democracy under siege, autocratic alliances are promoted. This could result in a shift in global power to a more fragmented multipolar model. Competition stands out as a potential advantage of moving from a bipolar to a multipolar world order. However, this shift could, on the flip side of the coin, threaten global security, causing new government alliances to be reached, and could trigger an increased focus on military spending. This is a segue to the fifth pillar collapsing, which involves a potential end to the so-called peace dividend that resulted when the Berlin Wall collapsed in 1989. Thereafter, growth flourished as spending on defense was reallocated to other economic and social priorities. What followed was a period of above-average economic growth and lower inflation. In recent times, however, a series of mutually reinforcing political shocks have hit the global economy in a very short space of time. More recently, Russia's aggression against Ukraine and the West more broadly have led to countries like the US to shift their focus towards rebuilding defense capabilities. As such, we believe this will result in a higher level of geopolitical risk going forward. The Economist Intelligence Unit warns that the war in Ukraine could extend to a downside risk scenario if conflict arises between Russia and bordering NATO member states. In a worst-case scenario, potentially involving nuclear warfare, major cities in the US could also be impacted. Although the probability of the scenario is deemed to be relatively low, it would have an outsized negative impact on the world economy. Other areas of the globe are also subject to geopolitical conflict. The unpredictability of the North Korean regime remains concerning, while Iran engaging in nuclear development enrichment raises the risk of a military confrontation between itself and the United States. Strained China-Taiwan relations pose yet another geopolitical danger to the globe. Conflict between China and Taiwan could lead to the US convincing other democracies to place inhibiting trade restrictions on trade, technology, and finance in China. A further deterioration in ties between the West and China could cause further decoupling pressures and induce supply chain disruptions. Global semiconductor supply chains, where the United States' efforts have recently been focused, have significant choke points in their supply chain that threaten to make microchips an even bigger geopolitical issue. Even though the US still holds a significant technological edge over China, Democrats and Republicans in the US both broadly agree that Chinese advances in digital technology threaten America's national security. Recent moves by America to prevent companies in the US from supplying Chinese chip makers with equipment that can produce advanced chips unless they have a license are quite damaging for this nascent but mushrooming industry in China. This move is likely to slow China's progress on weaning themselves off advanced chips manufactured elsewhere in the world. In this new old regime of higher volatility and less macroeconomic stability, the globe remains vulnerable to shocks, and as such, the IMF has urged policymakers to rebuild fiscal, monetary, and financial buffers to restore a higher level of economic resilience. This is particularly true for emerging markets, which have endured the spillover effects of rapid monetary policy tightening in developed markets, which triggered capital outflows and currency depreciations. With global financing conditions having tightened sharply, debt sustainability risks have increased for frontier markets in particular. Debt levels have spiraled higher and pushed up debt servicing costs. This has further reduced fiscal space and raised sovereign credit risks. A growing number of governments in less developed countries are now seeking out bilateral and multilateral support. Vulnerability remains high in tourism-dependent developing markets, where arrivals have not fully recovered since the pandemic. Developing economies that experience more frequent climate-related disasters are also expected to remain on the back foot. The World Bank shows that climate risks are rising and weigh heavily on small, vulnerable states, which have to safeguard agriculture and make infrastructure more resilient. In our view, rising geopolitical fragmentation poses a threat to achieving climate change goals, given the level of global cooperation required to accelerate the clean energy transition. Moreover, the Russia-Ukrainian war temporarily set back efforts to transition away from coal in both advanced and emerging economies. Despite major shifts in economic and political trends, these downside risks to the baseline view could be balanced out by some potential upside surprises that could deliver a better than expected outcome this year. Russian President Vladimir Putin's plans to squeeze Europe by weaponizing energy were dampened by milder winter conditions in Europe. This doused fears of a gas shortage and lowered the need to enforce demand management. While tighter monetary policy and slower global growth will weigh on European economic outcomes this year, a record warm winter so far has softened the bear case scenario for this region. Similarly, a faster pivot towards a relaxation in COVID-19 regulations in China has paved the way for a faster than expected recovery. Pressured conditions in the real estate market and health consequences of low immunity levels, as well as insufficient health provisions, pose risks to the expected rebound in China. However, pent-up demand could drive a stronger recovery. The IMF notes that for each additional percentage point growth in the Chinese economy, a 0.3% uplift is provided to growth in the remainder of the globe. A slowing global economy provides further headwinds in our own local environment. South Africa faces a tough situation with load shedding, anemic growth, unemployment, poverty, and widespread corruption. In addressing load shedding, government recently announced a number of interventions to alleviate the short-term crunch in energy supply. A new position in the presidency, focusing on the country's electricity crisis response, could fast-track the implementation of government's energy action plan through more decisive action. Meanwhile, the procurement of emergency power can lessen the intensity of load shedding and the negative effects on growth in the near term. Nevertheless, insufficient energy remains the #1 downside risk to growth. This is likely to keep trade growth below 2%. Load shedding has increased the cost of operation for businesses and as such weighs negatively on expected revenue collections for the next fiscal year. Risks to fiscal consolidation are also coming through from the expenditure side. Financial demands from other state entities, a more permanent form of the social relief of distress grant, and risks to a higher than expected wage bill to reflect cost of living increases all add to expenditure pressures in the medium term. Allegations and incidences of state capture, corruption, and the mismanagement of public funds have tarnished the attractiveness of SA as an investable destination. Public trust in state institutions is unlikely to change unless the fight against corruption gathers momentum, those who are guilty of wrongdoing are apprehended, and there are tangible indications of an improvement in the performance of crime-combating agencies. Given continued electricity woes, elevated criminal activity, a backdrop of slowing global growth, and noise around the Phala issue, levels of support are expected to drop for the African National Congress in the upcoming 2024 national elections. There is an increasing likelihood of a coalition government having to form in South Africa at a national level. According to research by the Social Research Foundation, support for the ruling party has likely fallen to below 50% on a countrywide level. This has the potential to further slow progress on developing a more comprehensive social compact with all economic players to reinvigorate a socio-economic recovery. Risks abound from persistent inflation, tighter monetary policy, geopolitical instability, and lower growth, making this another challenging year for investors. After an extensive period of generous liquidity and macroeconomic stability, investors are now faced with a considerably higher risk environment than before. Market timing will become increasingly challenging against a backdrop of higher volatility. As such, we would urge investors to not make any unnecessary changes to portfolios which could scupper their ability of building long-term wealth. In our view, successful long-term investing ultimately requires sticking to a well-diversified and sound investment strategy and avoiding reacting to short-term market noise. Thank you for your time.
That was quite informative, Sanisha. We truly appreciate your insights. And up next, our panel of experts will now give you a perspective on what remains or is becoming investable again, and what the new opportunities are. Moderated by our Acting Chief Investment Officer, Mike Adsett. Please take it away, Mike and panel.
Thank you, Michael. And thank you, audience, for joining us in today's panel discussion, which unpacks the theme of, is this a reset? We've seen over the last year, inflation increasing, and on the back of that, interest rates increasing, and we are moving into a world away from quantitative easing and accommodative monetary policy. So that raises the question, to what extent is the world reverting to some sort of normal paradigm, and in what ways is the world fundamentally different from what it's been over the last 2 decades? Joining me in studio today on my left-hand side is Rayon Yusuf. He's the co-founder and co-CIO at Centio Capital Management. Next to him is Herman van Papendorp. He's the head of research and insight at Momentum Investments. And next to him, Ian Scott, who is the head of our fixed interest capability. Joining us from Rotterdam today is Colin Graham. He's the head of the sustainable multi-asset team at Robeco Asset Management. So in terms of the discussion, let me start the question, and I'll direct the first question to Colin to give us a little bit of an outsider-in perspective. So Colin, just taking the current macroeconomic context, thinking back over the last 2 decades or so, where we've seen the dot-com bubble, the financial crisis, the COVID epidemic, and recently the Ukraine-Russia war, in what ways do you think the world is returning to some sort of orthodox monetary policy, and in what ways do you think things are actually a little bit different from what they have been in the past?
Well, thanks, Mike, and thanks for the invite to join this panel, and very glad to be here today. So I think that, firstly, I think you hit the nail on the head in terms of the monetary policy unorthodoxy after the global financial crisis. I think that's a key one where you've seen rates cut to zero and you've seen yields on nominal bonds being negative. And for me, this was very much a case of when you look back through textbooks, there is no way nominal bonds can be negative yielding. So from that perspective, I think that it's really the last 15 years that has been the unorthodox period, and we're going back to a more normal period where inflation isn't just in financial assets, it's also in goods prices and other such measures of price increases in the economy. I think where things have changed is where we've got used to having a single superpower and all the supply chains set up for one superpower and the largest economy in the world. That's changed, and we're starting to see, with the rise of China, we're starting to see a balkanization of those supply chains. You're starting to see a bipolar world where you're getting two spheres of influence. So I think that is something that is different for us to cope with now. And again, it doesn't necessarily shift overnight, but these are long-term themes that we have to think about when we're investing our clients' money. So I'm going to stop there and let other people jump in.
Yeah, so my next question is directed to Herman. Over the last couple of years, we've kind of seen an increase in the pace of financial markets, how quickly events happen, how once-in-a-lifetime events seem to be coming around every 5 or 6 years now. So the question to you, Herman, is, in the current world where we're very myopic, to what extent do we need to think about shorter-term cyclical trends and longer-term structural dynamics? I mean, a unipolar world is, in some senses, something that comes and goes through the ages. There's been many times in the past that there's been a bipolar world. So just your perspective in terms of kind of short-term versus long-term structural thing, do we get confused between the two? And what do you think is the state of play at the moment?
Yeah, I think, Mike, we need to draw a clear distinction between two things. Firstly, your normal cyclical shorter term kind of trends which ebb and flow with the normal business cycle, and that ebb and flows around some sort of an established or a prevailing mean. But then we've got to distinguish that with these longer term structural changes that we see, which takes us then to a new mean that we haven't had before. Now, if I draw sort of an example on the first one, the shorter term cyclical trends, you look at economic growth, you look at inflation. Those are very much normal pro-cyclical kind of variables that sort of goes around with the business cycle up and down. Now, obviously, for sure, we do have some supply shocks from time to time that can sort of destabilize this normal pro-cyclicality of these variables. But they're sort of very much shorter term kind of oriented, and it's still very much demand that's the dominant driver of economic growth and of inflation across a normal kind of business cycle period. So for instance, 2023 will be an interesting one because we'll see these cyclical kind of trends of global growth coming down, of inflation coming down, and that's going to be very much because of it's very much related to the business cycle slowing down internationally. But then we've also got these kind of structural changes that we've seen the last number of years already starting to happen. They've obviously already played out in the last number of years, and they're probably going to take this, what we were used to as our sort of stability around a certain level of average inflation or average growth, to some sort of a new level where we think actually over the next number of years we're going to see slightly higher inflation that we've been accustomed to, as Collins referred to, over the last 15 years or so, and maybe slightly lower growth in this kind of environment. And I think they're very much going to be driven by these two Ds, the deglobalization kind of theme, as well as the demographic theme. If you look at deglobalization, it's actually started really probably with 2017, the term of President Trump in the US, where we started the macroeconomic environment. We started seeing that was starting to change with these whole avenue of America first as the cornerstone of his foreign policy. And what that obviously then caused is that America started withdrawing from global organizations, global treaties, and that really caused basically a move back away from globalization that started, in the late 80s with the fall of the Berlin Wall first, and then the sort of disintegration of the Soviet Union in 1991. Now, globalization caused this whole positive impact on global growth on the positive side, and it pushed down inflation. But now we've basically, since 2017, we've gone back the other way, and we're starting to see that inflation is starting to move up, and also growth is starting to move down somewhat. So I think that's the first kind of impact that we're starting to see on the structural change side that we need to monitor for the medium term when we look at our asset classes. And then the second one that I mentioned, the demographic reality is that the retirees are becoming a bigger part of the world population, and the working class is becoming smaller. Now, the implication of that is that we will see somewhat higher inflation, because the retirees, they basically consume more out of the economy than what they produce, so that's inflationary, and they're getting bigger as a bigger part of the population. But then the working class, because they're getting smaller and they produce more than they consume, that's disinflationary. So your inflationary forces are much bigger than your disinflationary forces, which should have an impact on the negative side on inflation, pushing inflation somewhat higher over the next number of years. And these kind of structural changes of demographics as well as deglobalization, we're already seeing them playing out in some of the variables. I mean, definitely the case on inflation. If you look at the inflation trends, I mean, we've seen since US inflation topped out in the early 1980s around double digits, they've come down significantly and steadily over that period since the beginning of the 80s until 2017, when they bottomed, US inflation around 1.25%.
I just want to unpack something. So is your view that so we've been through an environment where there's been a strong peace dividend on the back of globalization and technological advancement, and also the rise of China with wage disequilibriums between different parts of the world. We've been through a long period of low inflation. Are you describing a structural change that's going to drive high inflation into the future, which does have benefits for certain investment and asset classes?
Definitely. I mean, I want to sort of refer back to what Colin said earlier. We're going back to a pre-global financial crisis normality. So it might seem strange for people being in the market for the last 15 years that this is a total new environment. But as Colin rightly pointed out earlier, we're actually referring back to an environment which was actually the normal kind of period. We were in the new normal basically since the global financial crisis, with quantitative easing and I want to almost call it abnormal monetary policy that we've seen. And we're actually just reverting back to a normal kind of pre-global financial crisis environment. So yes, it's structural relative to the last 15 years, but it is actually just going back to the normal kind of driving forces of the longer term variables like demography, as well as globalization, or in this case now a bit of deglobalization. I think deglobalization is somewhat different from pre-global financial crisis, because as I sort of pointed out, I mean, we saw actually globalization happening since the fall of the Berlin Wall, which was 1989. So again, you had let's call it roughly a 2-decade period of globalization up to the global financial crisis, and deglobalization is now going to be with us for the next number of years. So we're probably likely going to see some rising of inflation back to those kind of levels pre-GFC.
So I mean, it does really bring the question that there's going to be some investable and good investment opportunities, and some investment asset classes that are no longer giving you the premium that you would expect. So before I get to the local portfolio perspective, Colin, a question for you. As the head of a multi-asset team, you're keeping very close to what asset classes are coming into favor, what's investable at the moment. There's what hasn't been talked about earlier is the theme of sustainability, decades of underinvestment in infrastructure, specific or very much in South Africa, but it's a trend from all around the world. So there's also asset classes that you would want to invest in and not invest in. So just from your perspective, what is the investment landscape looking like from where you sit?
Well, I think there's always going to be demand for underlying commodities and raw materials. So I think that is not going away. If we look at the last major infrastructure plan in the US, which is going back to the the John F. Kennedy road building program, for example, and that was the late 60s. So, there are plenty of places around the world where infrastructure spend will help economies move forward. But because of deeper globalization, because of low inflation, there hasn't been that push to improve the infrastructure in order to get that the benefits from the productivity. So for me, that's a global theme. So infrastructure, I think, is going to be a theme for the future. It's also, if you have a mixture in your portfolios of greenfield sites, building sites, and sort of running the sites, you can see that when you run the sites, you actually get quite a good inflation pickup on the prices you're charging. So you're able to get some inflation hedge within your infrastructure allocation there. So your real asset pool, if you like. And then you're again thinking about those companies that have strong balance sheets, those companies that have pricing power. I think those are the companies that will do well. So the quality end of the spectrum will continue not only to protect you when you see recessions, which is most likely, given where we are, that the new normal will be more volatile GDP growth, because your inflation aspect will also be volatile, which we haven't really seen for the last 30 years. So for me, your nominal GDP is going to be far more volatile going forward. And therefore, stable returns will generate you returns. And picking up income, it will still be a major theme. So not just in equities, but also in the bond market. Now that we're getting back to levels you could consider normal. We've thought about the duration call, where we've been very short duration. We're starting to move long because we think, look at the US, we look at other long bond yields and go, well, 4% isn't that bad, given that growth is going to be lower and inflation, if the Fed continues and other central banks continue to put the pressure on inflation, it means that inflation will fall back, and the expectations around inflation will fall back. So, total return of 4%, when you're concerned about the global outlook in the short term, seems like a good place to put some money in the short term, but always looking for the opportunities as they arise and as the pricing becomes correct for your long-term returns.
So, there's a whole host of acronyms. So for the last couple of years, we had a very famous one called TINA, which is There's No Alternatives. And with inflation and interest rates going up around the world, there's a whole host of new ones. The one that I do like is TARO, which is There Are Real Alternatives. So my next question is to Ryan. As the co-CIO and guiding and investing portfolios, there's a lot of shorter term and longer term changes. So things can be a good investment, but it might take a very long term to play out versus good current investment opportunities. How do you think about and position portfolios for the current environment, and how sensitive are you in terms of trying to pick up longer term cyclical and structural themes in terms of your portfolio management?
Okay, that's a very, very important question, and it's a difficult challenge and problem for every asset manager to solve. So what we've been noticing is that the longer term, especially since COVID, is becoming increasingly shorter term by historical standards, where fund managers used to take 2 to 5 year kind of views to structure their portfolios. It became 2 to 3 years and then 1 to 2 years. And to be honest now, everybody's just taking short-term views. 3 to 6 months has become like the horizon by which people are actually allocating assets, which is a problem and a concern for us, because it could lead to suboptimal capital allocations. In other words, everybody has a shorter-term investment horizon. We can all see what's happening in the next 3 to 6 months. We all clump to the same assets, and you have misallocations because of that. So that creates opportunities for people who take longer-term views. So we're trying to make sure that we optimizing the portfolio for shorter term outlooks because it's a risk management decision, because if you don't do the things that are correct for the next 3 to 6 months and you underperform by too much because of that, you know, you lose money for your clients and you create stress within the business. But at the same time, we're trying to balance that with longer term kind of capital allocation decisions as well, which you have to do because that's where the big opportunities are. So the way we're looking at the world at the moment from a longer term perspective, you know, my fellow guests here have mentioned it, so I won't repeat that. But just to summarize effectively, you're going to have a lower growth profile globally for economic growth effectively. It's going to be more volatile at the same time. So volatile and lower economic growth. You're going to have a higher cost of capital and probably also volatility in that cost of capital as central banks have to respond to a very volatile inflation kind of outlook. Both those outlooks don't look particularly great for equities. So effectively, you've got your PEs, your DCF kind of valuations that need to shrink. Yeah. In particular, companies that have a growth kind of, a very long-term kind of DCF. So those companies where the earnings are very longer term versus shorter term. So tech companies in particular. We've seen a lot of that in the last year, but longer term, we're probably going to see more shrinkages in those valuations. So growth valuations, stocks of growth companies, valuations coming down. Value companies probably leaking upwards as a result. So this structural underperformance that we saw in value versus growth over the last 15 years, that disappearing. We've seen some good recovery in value stocks last year. We think longer term that valuation gap's going to continue to close and value continues to do well versus growth. That's a structural theme that you want to actually play. But at the same time, you need to also look at the shorter term outlook. You know, we're very concerned about the economic growth outlook for the globe. We've had, by the time of March, 4.5% of cumulative rate hikes in the US. You've got a very steeply inverted yield curve. If you just look at all of the points in the yield curve in the US, roughly 90% of those points are actually inverted. That's as bad as it's been, you know, relative to the history that we've looked at. So there's clearly a very high elevated risk of global recession, which will bring down earnings, which is obviously going to impact cyclical companies, or companies that have a very cyclical kind of bend to them. So you need to be careful about this longer term structural support for value companies, for commodity companies, for mining companies, which are very value centric, with the shorter term cyclical outlook, which could look actually quite horrid. So we're thinking that's probably a bit of time away. We think that's probably about 6 months to 12 months away. We actually need to be very concerned about cyclical mining kind of companies and cyclical assets. The short-term outlook looks great because a lot of them have come off from a valuation perspective. China's recovering from a growth perspective. US slowing, like we said, and we're concerned about it, but it hasn't yet fallen into recession. It's still holding up from a growth perspective. Europe seems to be coming out temporarily from a growth perspective because they're catching the Chinese recovery from a coattail perspective. The energy crisis wasn't as bad as what everyone expected. Gas prices came off. So you're seeing a slight recovery in Europe. So in that short-term window, valuations have come off. A lot of bad news has been priced in. So you want to be quite cyclically positioned in the short term. Watch out for the recession. You need to get out of risk assets for that recession. And then longer term, get back into these value names and these cyclical names and structural names for the longer term theme. So you need to have a very clear plan for how you're actually going to be managing the portfolio going forward. You need good data to guide you in that process, and that's why you use a lot of machine learning data processes to guide that path in terms of buying and selling. And you need to get your timing as close as possible, right? We can't time markets perfectly, nobody can, even with machine learning and data. But you need to get that timing as close as possible to make sure that you don't lose too much money in the short term while you're looking at the long-term opportunities at the same time.
But it really talks to how dynamic investment markets are and how dynamic you need to be in terms of your investment selection. I mean, longer-term asset allocations are very critical decisions. And I just want to ask a question to Ian, because, you know, you've always been the local bond guy, and, you know, we've moved away from there's no alternative in the global space where yields were extremely low to where there's actually real viable offshore investment opportunities in the fixed income space. So I suppose I've got a two-pronged question for you, Ian. The one is just describing the current fixed interest opportunity set, and we've recently just got the grey listing announcement, which thus far seems to have been priced into the market, so not a major shock. But just your perspective in terms of the current positioning and opportunities in the fixed income portfolio set, mindful of the macroeconomic environment, and how you start thinking about the influence and positioning for global assets in the fixed interest space.
Well, Mike, I disagree with the whole notion of there's no alternative. There's always an alternative, and I think what's changed massively is Q, and Q is not over, because the one thing that's not been said is that we think that this is it for central bank balance sheets. So remember, there's two policy tools. One is interest rates and the other one is the balance sheet. And we've been focusing the last year or more purely, and the Fed is purely focusing on that interest rate side, but the balance sheet is still 8.2 trillion. If you look at the ECB balance sheet as well, over 8 trillion as well. So I mean, really, if they are serious about combating inflation, you should make that balance sheets 5 trillion or 4 trillion. That will bring inflation down, but unfortunately it will have a negative growth effect as well. So I think there's alternatives, and I think what is structural is that if there is going to be this recession that Ron talks about, and what we are seeing in the curves, and they are deeply inverted, 2v10 in the US is minus 90 now, don't be surprised if those balance sheets go up again. I think that's the one level that has really structurally changed the way that central banks run balance sheets, but also the other way is the printing press on the fiscal side. So I think we should also not be surprised if we look at the US and say, look, if these guys need money, they're going to run the printing press. They'll move the debt ceiling out again, like they'll probably do very soon, and then the fiscal side will just print more bonds, and the central bank will buy them. So you get this debt monetization that will keep on happening. So I think structurally that changes and it underpins the way we think about monetary policy, especially from the US. Bringing that back to local, well, notwithstanding our own little idiosyncratic factors here in South Africa, we don't have to delve into them, is that the one fact that's quite important is that inflation is coming down. The SARB has been very hawkish, but there's still real yields that's attractive in South Africa. And we've been pounding the drum and saying for quite a while that nominal rates look attractive to us, and they do remain attractive to us. But what has changed, and if Herman is right, that inflation is structurally going to be higher than what it has been over the last 20 years, well, then inflationary bonds suddenly come into play. And if we think that you probably get around 5% real yields on nominal bonds, we're probably close to around 4.5% real yields on inflation bonds, then both asset classes look attractive to us. So we still remain of the view that duration is still attractive, and you get paid for taking some duration in the portfolios. I think something cyclically that has changed is that typically pre-1989, interest rate cycles typically used to be 3 to 5 years. I think that's now shortened. I think interest rate cycles are going to be much shorter globally, that you're going to find that in 1 year or 18 months, the central banks hike rates because they're worried about inflation, and then inflation falls, and the next moment they start cutting rates again. So I think those 3 to 5 year cycles on a cyclicality basis have probably changed quite dramatically going forward.
You're the one person, so grown up in the investment markets, I've always heard the saying, don't bet against the Fed, but you take it one step further and say, don't bet against the bond market. Is your view that the Fed, through the course of the year, we are reaching the top of interest rate cycle? Kind of, what's your thesis there, and how do you think, and why do you think we are in it for the top of the cycle, or top-ish?
Well, there's only so much that the central bank can do. And as I keep on saying, the guys are only pulling on one string. They haven't changed the balance sheet number. I think it's pretty clear that, once the Fed, and they talk very hawkish, and you can always understand that they want to talk hawkish in this environment where it seems inflation is going to be more sticky in the US, but the trend is still down. So at some point, they're going to take the foot off the brake, and they probably say, well, the market's always debating, is a 5.25%, 5.5%, or 5.75 actually the top for the Fed funds rate, and it's quite important, obviously, for risk assets. But somewhere with a 5 handle, they are probably going to stop. But I think if you really see the US economy really getting hurt, and there's some form of hard landing like the bond market is predicting, well, then they're probably going to cut rates again. And it's always important, because you've got this zero bound on interest rates. I'm always of the opinion that the Fed and the SARB and these guys always want to have ammunition the day that things go wrong in the economy, that they do want to cut. So the Fed is actually in a very nice position that, look, if things go wrong in the US over the next 3-6 months up to the end of they can probably cut rates again, because there's scope now to take it from 5 or 5.25 all the way back to a 2 or a 3. I think there's less opportunity in Europe and in England. I think the BOE and the ECB, they started too late to the party. Now they just have to keep on hiking, because the real rates in Europe and the UK is probably way too far negative at this point in time. But I think the Fed and the SARB is actually in a good space where you could probably see that they've got good opportunity to cut rates when needed, and it's not if needed, it's when needed. That cycle is going to be shorter.
So just in terms of the current very dynamic environment, Herman is responsible for our strategic and tactical asset allocation views. And having listened to the conversation, there's a lot of drivers and a lot of counter drivers in the market. I just want to get your view in terms of, from an asset class perspective, where do you think the good opportunities are at the moment, and where do you think as investors, obviously depending on your duration, so a longer term investor can sometimes stick through the difficult times, but you need to know where you're coming from. So where are the good opportunities, and where are places where you think investors should tread with caution?
I think, Mike, the first one on the tactical asset allocation side for 2023 is, I think we will not see the same non-hedging characteristics from global government bonds that we saw last year. I mean, last year was a bit of an exception, I think, that we saw both global government bonds and global equities got carried out at the same time, because you had that lethal combination of an environment where growth was starting to slow down, but inflation was going up. And obviously that just derailed global government bonds as a hedging instrument. And I think what we'll see this year is, with the business cycle telling you that we're likely to see inflation coming down significantly this year, we're likely to see the return of that hedging characteristics of bonds in a global diversified portfolio. So very much unlike last year, we'll probably have a bit more of global government bonds in our portfolios as a bit of a hedge against the downside risk of potentially a significant slowdown globally, maybe even recession in some areas of the world. So this is one of the areas. And I think, again, coming back to your theme of Tina and Tara, I think that because we saw the significant increase in monetary policy tightening last year globally, combined with obviously bond yields running up quite significantly, you actually now have fixed income assets globally as viable income alternatives for equity. So they're starting to look a bit more interesting on the equity side, where for many years you'd rather want to earn your income from the dividend yields on equity, because government bonds were just nowhere. I mean, Colin alluded to the fact that, in nominal terms, some of them were negative. So if you did hold them to maturity, Colin, you would have bedded down a capital loss, which is just unheard of as a fund manager. Now, obviously, you wouldn't hold them necessarily to maturity. But I think that those are the kinds of things, Mike, on the tactical side that we look out for this year. I think China is an interesting one as well, that where, I think in the middle of last year, a lot of global fund managers started talking about China as an alternative that wasn't there either, that you became uninvestable almost in the lexicon of a lot of global investors. And I think, the fact that China's reopened its economy, the fact that they've softened down a little bit on the regulation side, that is making China a little bit more attractive now on an investment alternative as a region for global equities, and I think for global fixed income as well. So that's very much the tactical side. Obviously, the strategic asset allocation, the longer term trends that we talked about earlier, if you talk about deglobalization, you talk about demographics, I mean, these kind of factors will also drive your kind of views on longer term kind of assets. And I think firstly on the fact that we say, well, if you have deglobalization, you'll probably have a little bit of lower global growth. That must come from top line negative. You've got slightly higher inflation, so let's call it higher wage growth. You've got high interest cost. Because inflation is higher, that means interest rates have to be higher the next 5 or 10 years globally. So a combination of those two say to you that, your margins will be under pressure as well. So top line under pressure, margins under pressure, that means falls down to the bottom line. Profit growth will be somewhat lower over the next 10 years. And then if inflation is higher and interest rates are higher, it has to have an impact on ratings of equity. So again, ratings negative, profit negative must say to you, my expectation for the kind of returns over the next 10 years that I can get from global equity is probably going to be somewhat lower than what I expected the last 10 years, where we had a different global kind of environment than what is likely to play out over the next number of years. We'll probably see the combination of demographics and deglobalization also causing all asset classes to have higher volatility, to probably have lower returns. We talked about equities now, but I think it's more of a general kind of theme as well. I think what you will probably see, deglobalization will probably mean that there will be more geopolitical strife in the world, because countries will now jockey for position. They will now sort of push their own agendas to the detriment of other countries and to the detriment of the world as a whole, which is very much the opposite of what we saw in globalization, where volatility actually came down significantly in asset classes. And I think for the next 10 years, you're not going to see that. If you look at emerging markets love globalization because obviously they benefit from the export variable right through into the economies and also into their financial markets. And now if you've got deglobalization, that's obviously making emerging markets less attractive. I don't say we will never invest there again, no, surely not. But I think it just makes the argument a little bit less positive in a deglobalized world than in a globalized world for emerging markets. And obviously South Africa is in that emerging market bucket. So again, you could probably say that, you know, if you have a deglobalization trend the next number of years, you're going to see lower returns in global emerging markets, lower returns in South African equity market, for instance, and probably higher volatility. So I think these are the kinds of variables that we look out in our strategic asset allocation for our portfolios.
So I think one thing I want to pick up, the big wild card, in my opinion, for this year is going to be China. So China surprised on the upside when they moved away from the zero COVID policy and they started opening up their markets as well. But I mean, there's been recent talk of potentially China supplying weapons to Russia, which can really upset the apple cart. So Colin, a question for you. From a South African perspective, we're actually fairly dependent on China from a resources perspective. NASPA's process is also heavily dependent on what happens in China. And in some of our conversations, we have positioned that South Africa geopolitically is a little bit closer to China than the rest of the developed world. I just wanted to get your take on how you see China, what the risks are, and what you think is going to be the drivers and the impact of China as a massive component of global economic growth.
Yeah, thanks for that question. I spent a couple of years in Asia, so I have a heavy skepticism of US rhetoric around China. And so I'm always looking to fact check what they're saying on how they're doing it from that perspective. And I think, from that perspective, then, China is here and it's here to stay. So we have to work out how it's investable. I totally disagreed with the comments last year in terms of China's become uninvestable because that's just blatantly wasn't true. And that was a story coming out of the US. So from that perspective, I think that this is a bigger theme. And I think that we've talked about the sustainability and where to invest. And I think that as investors for the longer term, the more thematic approach is probably a better one. And you feel safer at the moment moving down that path because we can see there are massive spending programs going on in the US, Europe, and China. So you can think about the world as you want to invest alongside governments. So the electrification of driving cars, the upgrades to the grids, the renewable energy transition, I think is areas where you can take those long-term thematics because the growth rates and the demographics and the industry growth is all there and it's supported by the governments. So for me, I would be looking globally and saying, okay, which companies are going to benefit from these big spending plans that we're seeing that are coming out of the US, Europe, China, India?
I mean, the other thing that you touched on was sustainability, which is, in my opinion, at least one of the structural changes that's really going to kind of get embedded and entrenched in portfolios. So I've actually got questions for both Rayan and and just in terms of your take on sustainability and what it means in a multi-asset portfolio for Rayan, and for Ian, what it means for you in a fixed interest portfolio. But Rayan, if I can start with you.
I think it's you've got to separate E, S, and G into three different components. For us, G is always about avoiding stock bombs, your Steinhoffs and your Tongarts and a whole host of names that have gone bust effectively. So you need a very strong governance framework, governance process in your investment process, which is not the legislated governance process in terms of King Commission and all of those tick box kind of stuff that people focus on. It's actually real governance, actually trying to understand how companies manage themselves, how they behave, the corporate culture of that company. And that only comes from interacting with those businesses, understanding the deep fundamental makeup of those businesses and the management of those businesses. So G is all about, avoiding stock bombs, protecting alpha effectively. S really revolves around sustainability of South Africa as a country in particular, in terms of the social stability of this country. It's something that we have a significant concern around, with the elevated levels of employment and all the difficult questions we always keep asking ourselves. How to solve that problem is a particular challenge for us, especially considering the E issue, which is pretty much a very strong global focus at the moment, not necessarily in South Africa, as we can see now the controversy between the outgoing CEO of Eskom and the ministers in terms of whether the government actually supports some of these the E initiatives of Eskom or not. So E is all around the global perspective around cleaning the environment and leaving a sustainable environment for our future generations. And in the E is going to be significant opportunities for like the guest mentioned earlier, electrification of vehicles and the grid and the investment and the infrastructure investment that's going to go around in the developed world around that. There just is not enough commodities, in particular copper, at the correct grades to supply that demand. I mean, supply is becoming an issue also in the commodity complex. I mean, platinum is becoming an issue, palladium is becoming an issue because of the geopolitical concerns around Russia. So supply is going to be the problem, and the demand is going to be strong. And that's why we like the longer term value cycle in terms of all of this infrastructure spend together with the weak supply. It's going to be a great opportunity for miners. That's why we like mining companies, especially now that they're getting sold off.
We need to sort out the rails.
We need to sort out the rails. So how you solve that problem is you need to invest in companies that aren't hamstringed by Eskom. I mean, also the other issue is Eskom. If there's no electricity, there's going to be no supply. Costs are going to go up and volume's going to drop. So you want to favor mining companies globally listed. So a company like BHG and more Anglos rather than more domestically focused kind of companies. But at the other end of the scale, those domestic companies have been so oversold at the moment. Valuations are so cheap. The opportunities in the platinum space, for example, just looks like a sitting duck to us. So notwithstanding all of these structural issues that South Africa is going through, and it also applies to our domestic names, by the way. I mean, a lot of the food retailers and banks. So much of bad news is priced in that you have to actually look at there's good alpha opportunities there. So when the ducks are quacking, you want to be feeding into those ducks, and when the ducks are getting slaughtered by for whatever different reasons, you need to look at opportunities there, because there's clearly alpha opportunities in there. So we're seeing good alpha opportunities in some of these mining companies, and good alpha opportunities in the domestic bank opportunities, notwithstanding all of the structural issues, notwithstanding this imminent recession that's also we feel very likely as well. So look there, and we're seeing good opportunities there to make returns.
Yeah, we really need government to get its ducks in the row
absolutely.
Turn the South African potential into South African reality.
Absolutely.
Yeah, and I just want to come back to you, because you're part of the engagement with Eskom as part of the Climate Action 100. So just your take on sustainability, your Eskom perspective, but generally within fixed income, how are you thinking about sustainability, green bonds in that landscape?
Well, Mike, I think the bond market sits right at the heart of this whole project. I mean, there's all these projects from IPPs to sustainability bonds, they're all debt financed. I mean, we basically co-finance with the whole banking sector, all these IPPs and renewables and sustainability bonds. And we've seen last year that about 15 billion of green sustainability bonds were issued in South Africa, and we can probably see that this year it's probably going to just increase massively in size. So there's a huge pool of assets being allocated between the banking and the asset management and the pension fund industry to this sustainability and green bonds. I think the most important part is just what is that green premium that we're willing to accept to actually participate in these assets. Talking around Eskom now, it's obviously it's always easy to say, Eskom is a no-go zone, which may not be totally correct in terms of, yes, we're obviously very concerned around what is happening in Eskom, but just from a bond side, it's got the best government guaranteed out there. So for us, we look at Eskom as purely looking to the sovereign, and after the budget of last week, we can clearly see why we think it's a sovereign issue, but it's probably a sovereign issue with a very nice spread.
Yeah.
And we're also part of the whole investment industry, thinking that, you know, as much as we don't, from a personal perspective, we don't like Eskom, we also recognize that we've got to support them, because there is a just transition. We can't just literally switch off the power stations like we do at the moment and think something magically will appear. There is a transitioning process, right? And we have to move from coal to IPPs to whatever is next, right? And yeah, I mean, if you listen to what they say, unfortunately, coal is probably going to be with us until the lifespan of Medupi and Kusile is 2071, if we can listen to Eskom. I don't know if it's going to be that long, but what we are saying is, in that period, we are going to support Eskom, because we literally can't afford to have the lights off for a protracted period of time. It's just got too big an impact on the economy. So, yes, we have to support them, but it doesn't mean we support them blindly. We have engagements with them, and, you know, we have very tough negotiations and discussions with Eskom and the likes, and say, guys, what are you doing? What is the just transition? What's happening here? What's happening there? So, but the bond market sits right at the heart of this green energy transition, if we want to call it.
So before I get to the final wrap for today's panel discussion, I just want to ask around, just in terms, like, you've listened to the conversation, you've listened to the SAA and TAA views, you've got your own very particular views. How have you been positioning yourselves to take the current environment into account?
Okay, so I mean, we are very conservatively predisposed in terms of the global macro environment, like we've explained. You need to be very careful of this recession. You need to be careful of the structural implications of high inflation and higher rates, all those geopolitical risks that exist in the world. We really see those risks as relevant risks that need to be factored in. But at the same time, there's a short-term window of opportunity where valuations have priced in a lot of negative news. But at the same time, you know, all of these risks that we're concerned about have been pushed out a little bit. We see the window at least 6 to 12 months where we can actually make good alpha in our portfolio. So we are taking risk in the portfolios. It's not irresponsible risk in the portfolios. It's a very measured and calculated risk. Resources, for example, domestic companies like banks also benefit from this renewable funding kind of projects that are taking place in South Africa. Some select retailers, some very good quality retailers, companies like Pep, Mr. Price, priced in a lot of bad news there because of all of the load shedding concerns and all the economic growth concerns that we've got in South Africa. So these are typically very good quality companies that are trading at very attractive valuation. So we think there's this window of opportunity to make cash, make decent alpha in those names and those opportunities. And then we're going to be selling into strength, because at some stage this global recession, which we're very concerned about, and we think it's almost inevitable, will hit the globe. And you need to be de-risked from a risk asset perspective. You need to be then underweight equities, underweight risky bonds like SA bonds, and overweight global bonds, and overweight global quality stocks in your portfolio. And we're positioning gradually for that, and that's the plan effectively over the next 12 months.
We've got a home bias, and as South Africans, we very often think, South Africa is a lot worse than what it actually is. And in times of exuberance, we also think South Africa is a lot better than what it is. And my personal view is we're in a stage where we actually think South Africa is in a lot worse situation than what it currently is. So that's something to bear in mind. As I close up the panel, I just want to ask each of my panelists, and then I'll go around the room just to give some closing thoughts and comments in terms of what the audience, the Guru's attendees, should think about in terms of the current environment. So Colin, let me start with you. Your closing thoughts.
So my closing thoughts are around the choice between equities and bonds. So the equity risk premium is at a very low point that has been over the last 20 years. So for me, that's telling you the additional risk you take on for taking equities over bonds won't be rewarded in return. So for me, it's being defensively positioned on the equity side. Having said that, we like emerging markets over developed markets within equities, mainly because valuations are very cheap. So there's already a slowdown priced in. then you have a US dollar that's likely to fall, and you've got China reopening. So, my question to the team was, well, if you don't invest in emerging markets, when else would you? And it was very difficult to narrow down a sort of more positive scenario for emerging markets in our future looking world. So we also have high yield in our portfolio. So that's really a sort of a delay of the recession trade. And that's likely the sort of like the most fragile position we have in our portfolio that was likely to take out as we de-risk. But if we think this year, I don't think the Fed will be able to cut rates, because what is different this time is inflation sticky and above the 2% core inflation target that they have, and unemployment's at all-time lows. So, from that perspective, they have the ability to cut rates as they have had in the last 20 odd years. So for me, don't underestimate the Fed. And I'll leave it with everybody saying, we didn't fight the Fed when they cut interest rates, so don't fight the Fed when they raise interest rates.
Thanks for that, Colin. And with that close, the next person I need to go to is Ian. Just in terms of your closing comments, and potentially, I know you've got a bit of a counter view to that.
Thanks, Mike. Yeah, I still am of the opinion that South African nominal bonds look attractive, and it is a home bias, but the real rates are attractive. I think what is screening more attractive suddenly, which wasn't attractive, was inflation bonds, because we've seen them derate quite a bit. So real yields in South Africa look attractive. Cash rates in South Africa look phenomenally attractive. I mean, the 1-year NCD is sitting at 8.75. Now, if inflation this year is at, call it 5.75, I mean, to get 4% real from cash, I mean, that's 3 to 4% real from cash. I mean, that's very attractive in any guy's book. Interesting, Colin talked about high yield here in South Africa. We don't necessarily own momentum. We don't necessarily call it high yield. We call it the private debt markets. Yeah. And we have to agree, we're finding very good opportunities in the private debt market at this point in time. Very interesting deals that you won't necessarily find in what we call the listed rated DCM market. So yeah, those 4 assets we think are great opportunities in South Africa. From a Fed perspective, I hear what Colin says. I'm just saying that, don't fight the Fed, but the Fed should also not fight the bond market, because that inversion of the 3-month 10-year, there's 2 things about the inversion of the yield curve. One is now the duration. From the middle of last year, the curve was inverted, so it's been probably 9 months now, which is quite long in duration. Yield curves don't stay for long in inverted. And then obviously it's the magnitude. 90 basis points of inversion in 2v10, that's quite a lot. So I don't say that they are going to just flat out cut rates, but I think the risk is there that if there's going to be some sort of recession or hard landing, like Rohan is saying, don't underestimate that the Fed will react to the bond market, because what you probably don't want as the Fed is that you get a negative reaction like we saw in the UK in September of last year, and the bond market revolves, because that's a nasty situation. So the Fed should also force the hand of the US bond market. But yeah, overall positive on bonds and South African fixed income from our positioning.
And Ryan, your closing thoughts?
Yeah, so I mean, maybe just as a funny analogy, there's a party going on in this house, and the parents are about to come in to the door. They're not quite there yet, so enjoy the party while it lasts, but stay close to the window, because when that door opens, you're going to be jumping out, because you don't want to be the guy catching the hiding when the parents get angry. And the analogy is all about having a very sound risk management process. And making sure you're not taking too much risk in specific asset classes or specific sectors or stocks. It's going to be very important to have your risk management right, because I do stress it's very good to get your timing right. It's very important to get your timing right, but it's very difficult. If you don't get your timing right, you need risk management processes to make sure that you don't lose too much money.
Well, that's important, and I can see either you had very strict parents or you are a very strict parent. And Harman, you have the oversight in terms of the views, the strategy, the positioning. Your takeouts for our audience.
Yeah, I think, the first thing that we've been telling our clients over the last number of years is that if you look at strategically over the next number of years, you're likely to see an environment, because of these structural changes, that are really going to induce probably somewhat lower returns in a portfolio for a multi-asset investor, and probably at a bit of higher volatility. And I think what we've discussed today is very much telling us that same thing, that we need to just realize as investors that if you take a longer term view, yes, I mean, the market will do well for you, but don't look at the last 10 or 15 years really as your yardstick for the kind of returns you can expect, because we would like to see the next 10, 15 years probably slightly lower returns at a higher volatility. But then again, if you look at the next 12, 18 months, there are opportunities out there. When markets react significantly, markets always overreact. And you've got to look at those kind of opportunity sets that actually produce some alpha for you in the shorter term. Again, obviously Ian has mentioned, but in our tactical asset allocation, we also have a strong favorable view on nominal and real bonds at the moment, because they give you decent kind of real returns. And we don't know whether there will be a recession or not be a recession internationally. And I think when we as investors basically come to that conclusion that we don't know, then we probably don't want to be too aggressive. And then when a specific instrument gives you quite significant real returns at relatively low risk, they're not riskless, obviously, but at relatively low risk, then you can say, well, I'm basically going to use that margin of safety that's available there to really try and underpin my longer term views by some shorter term tactical views in some of those areas of the market that have just overreacted to negative news.
So thank you to the audience. I mean, for me, the key themes that have come out is, this time it might be a little bit different, but it's not totally different. And the one truism in investment management is there are going to be investment opportunities. You just need to be alive to the opportunity, and diversification and risk management is key. As much as we hypothesize about what the future looks like, you never know the timing, and you never know exactly how the world's going to change into the future. You need to have a dynamic process. You need to do sound and thorough research, and need to be close to the market. And I mean, this is an interesting space. So I thoroughly enjoyed the panel discussion, and thank you to all my panelists. Thank you, Colin, Ray, Herman, and Ian. I hope you enjoyed this panel discussion as much as I did.
Thank you, Mike and panel, for that powerful talk. We've all learned a thing or two and gained more knowledge into investment landscape. And now, Keegan Dodo, who is one of our fixed income fund managers, will evaluate the various opportunities and risks that fixed income investors face during this time, and will discuss teams' positioning given the market outlook. The stage is yours, Keegan.
Thank you, Mike, and hello everyone. Since the start of COVID, the world has been in a volatile period. We had periods of economic turmoil, geopolitical issues, as well as ecological events that all point to have an impact on the global outlook. Inflation soared to multi-decades high, prompting rapid monetary policy tightening and squeezing household budgets, just as the COVID pandemic-related fiscal support has been waning. So there's also been many low-income countries which face deep fiscal difficulties. At the same time, Russia's ongoing war in Ukraine, tensions elsewhere, has raised the possibility of significant geopolitical disruptions. Despite sticky short-term inflation expectations, the longer-term outlook for inflation prints look a lot better. When we look at advanced economies, inflation expectations have peaked and have started to recede, which is captured in the outlook from the IMF inflation report as seen in the chart. With that said, central banks have experienced a tough time trying to balance hiking interest rates, keeping inflation under control, and at the expense of economic growth. The Fed has been a bit too late to the party. As a result, they have had to play catch up, and the market expectation for the Fed's funds rate has now peaked at 5%. However, inflation in the US remains sticky, and the forward market is anticipating that the Fed funds rate move much higher than the 5%, which is also captured in the inflation outlook report from the IMF. As a result, this will have an impact on South African bonds, as we will probably see our bonds go a bit weaker following the US curve. When we move to the MOVE index, the MOVE index measures the interest rate volatility of treasury bills through option pricing. So the MOVE index has been at multi-record highs and has peaked at a time similar to that of COVID. 2022 was the most volatile year for bonds, given the rising geopolitical risk and the continued war between Russia and Ukraine. As a result, we have seen volatility in DM yields, and they've remained elevated and extremely volatile since the beginning of the year. Given the high interest rates, we have seen DM yields move higher, especially with the US 10-year moving above 4%. In Europe, yields have moved higher, and central banks have suggested that inflation expectations about future inflation is a bit too optimistic. In addition, we have seen a strong dollar and a tight labor market, which resulted in a risk-off for emerging markets. In addition, given the geopolitical concerns and China's recent opening, we can expect to see further volatility this year in our view. When we look at the real yields for emerging markets at the time that I ran this analysis, most emerging markets have experienced negative yields. South Africa is one of the 7 countries to offer investors real yields, coming second to Brazil, followed by Indonesia, to name a few. In reality, South Africa should screen as a good opportunity for investors, especially those seeking yields. However, we are all aware that despite the good yields that bonds offer, it does not come without risks. And that in turn sways investors to other countries that offers a much more stable risk-return outlook. Looking at the inflation cycle, higher than expected headline inflation and rising core inflation led major central banks to accelerate monetary policy normalization. Despite core inflation in December, which came out significantly better than expected, increases in electricity and food price inflation, as well as headline inflation for 2022 as a whole, has been elevated, especially in the medium term. Although inflation expectations increasingly strongly over the last year, the SARB has anticipated that inflation will be sustainably below at the target band by Q4 of 2024. The South African Reserve Bank expects inflation to average 6.1 in 2023 and 5.6 in 2024. As a result, the inflation expectations are receding, and it serves as a sign that the interest rate cycle may be coming to an end. The market has priced in that the first cut may take place in 2024, that we may see in the following slide. So the market implied interest rates are captured by the FRAs, which are pricing in the cut by year end. However, the inflation still remains elevated and above the target band. So I think that the FRAs may be too optimistic when it comes to the future of interest rates. While we still have global inflation rates that are still elevated, I don't believe that the central bank or the SARB will cut while global inflation remains elevated. When looking at the real policy rates across various central banks, many are still in negative real policy rates. In other words, it means the repo rate is much lower than where the current inflation rate is. In South Africa, we are currently sitting at about a neutral inflation rate, more or less. Given the level of uncertainty, the market may be more volatile this year, given the market expectations around the future interest rates, which we believe is too optimistic. As a result, the South African yield curve remains steep, and it offers investors good buying opportunities. When looking at valuations from a break-even point of view, those bonds, especially in the front end of the curve, look attractive. Implied break-even suggests that inflation has come off from its highs of last year. The market is pricing in low inflation expectations going forward. However, long-term linkers relative to nominals are not attractive, especially when you look at the 10-year point and beyond. Despite the fiscal risk, which we are all well known, nominal bonds provide investors with a good margin of safety at these levels. Since the beginning of the year, the curve has become steeper and bonds still look attractive at these levels. Despite the fiscal issues and the impact of continuous load shedding that will have an impact on growth, we believe that these issues are all priced into the bond market and that the curve, in our view, will offer investors the opportunity to generate real yields. If we look at how the curve has moved over the last year, on average, the curve has shifted by about 2.5% across the curve, and it's all pricing in SA-specific risk, which we believe is already embedded in the curve. We've seen a lot of volatility in the CDS spread, and that has been driven by political noise in the country. As a result, we continue to see foreign selling of South African bonds across the curve. We have seen large coupons across both nominals and inflation-linked bonds in January and February, resulting in locals being able to absorb a part of the sell-off of foreigners. However, there are only so many coupons that locals can use to offset foreign selling. So given the steepness of the curve, we still much rather prefer to hold government bonds over other asset classes from a pure valuation perspective. So if we look at how we positioned, consider the Flexible Income Fund, one of our best investment view funds, which has a benchmark of CPI plus 2. So at this point in the cycle, we view nominal bonds as the best asset class, and we hold a small portion in those shorter dated linkers that offer value. With that said, our largest asset class in the fund is nominal bonds, which take up nearly half of the portfolio, as this is our highest conviction asset class. We are taking advantage of the steepness of the curve and are investing predominantly within the R2030s and 2032 space. If you look at the fund's duration, it's around the 2-year mark, and there's no direct exposure, as we do not want currency exposure within the fund. If we move on to the bond fund, there will be no surprises that we hold mainly government bonds in the portfolio. We do have a small exposure to inflation linkers, but that is also from a valuation perspective, and they shorter date in nature. We are currently long relative to the ALBI, but we remain cautious about the ultra-long end, which react to fiscal difficulties. We see opportunities in the belly of the curve, and we are positioned for a bull flattening scenario, and it did occur in the last week after the budget, but we have since seen that those gains have also been lost. For the bond fund, we prefer the asset classes, or the bonds rather, between the R2037s to the R2044s, and that's the belly of the curve. When we look at our linker portfolios, we're also currently running long relative to the index. Although we have not seen much activity in the linker market due to liquidity, we do prefer bonds up to the 33-year space, while we believe that longer dated bonds remains overvalued. As we are a valuation-based team, we believe diversification is a very important part of our portfolios, and therefore you will see nominal bonds in our linker portfolios. However, we are active in this market, and also we are able to sell those longer end positions when they make sense to do so. Finally, when looking at the various asset classes, cash yields can give us anywhere between 8 and 8.5%. Credit can also give us 8 to 8.5%, but that's not as attractive. When we look at nominal bonds, we're quite bullish nominal bonds, and especially taking advantage of the steepness of the curve, we believe that we can get anywhere between 11 and 13% in returns over the next 2 to 3 years, which you won't be surprised is our favorite asset class. In addition, we do prefer the money market rates anywhere between the 1 to 5 year space, but not necessarily a very short end. So just as a conclusion, we are going to be long to neutral modified duration in both our nominal bonds and inflation-linked bond funds where they make sense. We are also taking advantage of the yields we receive in the structured deal markets. So that is to enhance the yields of our portfolio. But just as a conclusion, we still believe that you should have nominal bonds and ILBs where they make sense in the portfolio, and just be cautious on credit and take advantage of the syndication market. Thank you very much for your time.
Thanks, Keegan. Next is Stanley Bishu, one of our smart beta fund managers, who will talk about the evolution of theories describing the fundamental drivers of share price, as well as unpack smart beta strategies informed by these theories and designed to outperform the market in long term.
Thanks, Mike. Today, I will unpack systematic ways of outperforming the market in the long term. I will start by looking at the evolution of theories that aim to capture the essence of the behavior of stock prices and the stock market as a whole. Then I'll move to investment strategies called smart beta strategies that are informed by these theories. Smart beta strategies are designed to deliver long-term outperformance in a systematic fashion. Then I will conclude by reviewing Momentum's track record of managing smart beta funds. Let's begin with an unlikely story of how a marketer and a regulator unwittingly sowed the seeds that would reshape the investment landscape. The story is well articulated in the book Trillions. I will retell an abbreviated version that highlights the relevant details to show the thinking and understanding of stock markets at the time. The year is 1948. Louis Engel is the vice president of a US brokerage firm, and he oversees marketing and promotion. Engel's mission was to make investing in stocks and bonds accessible to a broader target market at a time when the industry was only catering to high net worth individuals. He ran a print ad campaign in the New York Times, explaining investments in a language that made Wall Street accessible to Main Street. The ad campaign was a runaway success for many years. More than a decade after the first version, he drafted a campaign that made a bolder claim. The claim that equities were a good investment, even for ordinary folk. And this is the key of the story. Today, that statement is self-evident. But in the 1960s, the claim was so bold that the ad was stopped by the SEC, the financial regulator in the USA. The regulator requested for evidence that could back the claim that stocks were indeed a good long-term investment and outperformed bonds. But they couldn't. They couldn't produce the evidence because nobody knew the long-term return of stocks at the time. So the marketer and his brokerage firm funded the creation of the Center for Research in Security Prices, in short, CRISP, to collect evidence and create a data set of long-term stock returns. Without computers, it took 4 years to get an answer, but the CRISP dataset sowed the seeds that would reshape the investment landscape. To be sure, this was an era of transition. You move from an era where we are in the dark about the long-term returns of the stock market. The dominant thinking, explicit or otherwise, is that all of the returns generated by an equity fund manager is based on skill, or alpha as we know it today. Also, ideas about diversification begin to be solidified, leading to more rigor about the balance between risk and reward. In other words, portfolio construction. This is when we see the birth of the modern portfolio theory by Markowitz. It's the era of finance renaissance, and Chicago is the hotbed of intellectual activity about the nature of stock markets. You see an interesting marriage between investments, economics, and computing. William Sharpe was an economist and a computer programmer at a time when the computing industry was still in its infancy. Sharpe worked alongside Markowitz, helped Markowitz to develop and test his theories. Given the lack of computing at the time, they devised an efficient way to test his theories. They needed to calculate every pairwise relationship of stocks in a market portfolio. This required a substantial amount of computing power and hence time and money to test. Sharpe devised an elegant mathematical shortcut by simply testing the relationship between each stock and the market as a whole. In the computer program, Sharpe used the Greek letter beta to denote the sensitivity of a company share to broad market moves. A beta of more than 1 generally means the stock is risky or cyclical, a beta of less than 1 being interpreted as less risky or being defensive. This is the birth of the very first beta, market beta. To this day, our notion of manager performance and manager relative performance is informed by this very idea of market beta, where only a portion of a manager's return is driven by skill or alpha, and the rest being explained by the market or beta. Another idea birthed during the so-called finance renaissance is market efficiency. The idea that stock prices accurately reflect all relevant information. The interpretation at the time was that investors are only rewarded for taking market risk. In other words, they're only rewarded for exposure to market beta. The reward being returns in excess of a risk-free rate, such as a government bond. As these ideas get bedded down in the 60s and 70s, things become more interesting in the 80s and 90s. Another marketing campaign reappears in our story, but this time the marketer is armed with the crisp data set that shows the long-term returns of US stocks. This time around, a US small cap fund was being marketed. The fund was performing very well in the early 80s, and they needed evidence that the outperformance would persist going forward. Upon investigation, the crisp dataset did indeed show that smaller, less known companies did outperform larger blue chip companies. The outperformance exists even after adjusting for the higher volatility in the share prices of said smaller companies. Armed with the fund track record and crisp dataset, a case begins to be made for the existence of other factors, specifically market-beating factors. The efficient market hypothesis is being contested and begins to evolve. An idea begins to take hold that you have these other factors and not only the market factor. More importantly, there are risk premium factors which reward investors with long-term risk-adjusted returns in excess of the market. Factor, because it explains the long-term behavior of stocks. Risk premium, because exposure to the factor is rewarded with long-term returns in excess of the market. By 1992, Farmer and French release a landmark academic paper that revises the efficient market hypothesis and solidifies the idea of risk premium factors. They published a three-factor model to explain the behavior of stocks. It has the market factor, which is the original beta. It then adds two more factors, specifically two risk premium factors, which are size and value. These additional betas or factors that provide the reward of market-beating returns were then marketed as smart beta. Smart beta funds or factor funds describe the products that aim to harvest the risk premia delivered by these factors. Since then, thousands of factors have been identified. The question is then, practically, are these theories and stories useful? And more importantly, are they relevant to the South African market? Momentum Investment has done a substantial amount of work over the years to answer these very questions. Internal research shows there are indeed risk premium factors in the South African equity market. The momentum factor or trending factor is where you invest in past winners, shares that have recently outperformed. This factor delivered an average outperformance of 7.3% per year since 1996. The value factor, which includes companies that have a market value that is lower than their intrinsic value. The intrinsic value is typically measured using accounting data. As an example, the book value of a company. On the JSE, the value factor delivered an average outperformance of 3.4% per year since 1996. And the value factor is perhaps the most well-known factor in the South African market. The quality factor delivered an outperformance of 2% per year. This is a much newer factor that has a wider variety of definitions and interpretations. Broadly, it describes a company with a quality earnings base that delivers superior returns on capital. The size factor, a risk premium from small cap companies, has not materialized in the South African context. Looking at the same set of factors and adjusting the returns to account for volatility, you still see an outperformance relative to the benchmark. An important consideration is persistence. Once you've identified a market-beating factor, will that outperformance persist going forward? That is why it is important to have a disciplined and rigorous approach to identifying risk premium factors. it's key to also have a rationale for the existence of the risk premium factor, whether that rationale is economic, fundamental, or behavioral. This forces reflection and reduces the chances of identifying fleeting factors that don't perform in the long term. It also facilitates constructive discussions about short to medium term relative performance. The focus thus far in the presentation has been about long-term returns. The risk premium factors deliver market-beating returns in the long term. They provide a systematic source of market-beating performance, but it is important to understand the existence of factor cycles. This means that over the short to medium term, you will experience some underperformance. The duration of the underperformance can sometimes be prolonged, and the extent of the underperformance can sometimes be deep. The charts show rolling 5-year active returns for each of the 4 factors since 1996. These factor cycles of under and outperformance are variable and very difficult to predict consistently. We don't believe that timing the factor cycles can be done consistently and successfully to add value in the long term. So we advocate for a multi-factor approach to investing equities for an added layer of diversification. The graph shows the benefit of blending factors. Still looking at the South African equity market since 1996 and computing rolling 3-year active returns. On the left, a value-only portfolio would have generated a wide dispersion in return outcomes. The maximum outperformance over a 3-year period would have been positive 34.8%, but the worst underperformance would have been minus 16%. This underscores how deep the value cycle can be. However, looking at the bar on the very right, if you blended the 3 factors, you would have gotten a much higher medium outcome. But more importantly, you would have reduced the worst period of underperformance to only minus 5%. The tighter dispersion in active return outcomes balances risk and return more optimally. The blending of factors doesn't require the timing of factor cycles and can be implemented in a disciplined manner to add value over the long term. This can be done via blending the factors without the need to time the factor cycle. Also, the extent of underperformance has been reduced relative to a single factor portfolio. This added layer of diversification via blending of factors creates much more robust portfolios and more efficient investment outcomes for clients. This neatly summarizes market-beating factors in the South African equity market. This research provided the backing and evidence for the creation of Momentum's smart beta funds that are designed to harvest or extract the market-beating returns from risk premium factors. A note on sustainable investing within the context of smart beta funds. We don't necessarily view ESG as a risk premium factor. However, there are ways to sensibly incorporate ESG considerations into smart beta funds. The key is to have a clear ESG philosophy, one that is consistent with your investment philosophy. We prefer an integrated ESG approach that provides opportunities for incremental improvements towards more robust portfolios. We have gone through the evolution of theories about the behavior of stock prices. We highlighted the existence of market-beating factors and confirmed their existence in the South African market. All of this informed the creation of smart beta funds that were designed and are managed to extract the risk premium. This slide shows the performance of Momentum's smart beta unit trusts with live track records of more than 5 years. Both the Momentum Trending Equity Fund and the Momentum Value Equity Fund have successfully delivered cumulative outperformance, taking theory and research and successfully implementing in reality to deliver on investment outcomes for our clients. I thank you very much for taking the time.
Thanks, Stanley. Mike Assets will now summarize and close the webinar. Thank you for joining us today. Over to you, Mike.
Thank you, Michael. And thank you, audience, for joining us at today's Investment Guru session, where we really thought about, is this a great reset, and started unpacking the near history of the last 2 decades, where we've seen multiple financial crises, and the current regime, where we've seen increasing inflation and interest rates, and the context of the global economic environment is changing a little bit. Sanisha spoke to us about the economic perspective of how the world is staying the same and how it is likely to change into the future. And she really spent a little bit of time highlighting a key issue that is something that we need to think about quite carefully going forward. The last few decades, we've seen a massive peace dividend as we've seen regionalization of power and new alliances being formed. There's going to be a new economic and geopolitical context. I led a panel discussion where we unpacked the new macroeconomic realities and what investment opportunity sets are becoming available, and how portfolio managers and macro strategists think about investments and how to position portfolios for the future. Stanley spoke about smart beta and how this is becoming an increasingly important component of investment portfolios, where you try to deconstruct indices and harvest risk premium in portfolio. And Keegan spoke about the fixed interest opportunity set. Realistically, we're in a very difficult local environment, but there are investment opportunities. And within the fixed interest complex, notwithstanding these challenges, it is a good portfolio and opportunity set to harvest returns. Thank you once again for joining our Investment Guru session for the day, and we hope to see you in the future.
Thank you for watching today's session. Do remember that it's important to please watch the full session and add your ID number to the CPD section so we can verify your attendance. You may also view this event on this platform at any time until the end of April and still receive your CPD points. And remember, with us, investing is personal.